We continue with our discussion on Unit 4, and now that we have looked at all the possible approaches of arriving at an optimal capital structure for a firm, we are going to use the analysis to understand if there is actually a benefit to reach the optimal capital structure. So what is the value that comes up by reaching the optimal capital structure? That's what we are going to try and analyze at this point of time. That's what we're going to try and work on at this point of time, right? So what we're going to do is try and understand whether the equity value actually changes, and if yes, how do we know by how much would the equity value change by, right? So does it change, and does it change by a big amount, or what is the magnitude of the change that comes in, right? So now let us assume that we will follow our first approach of capital structure optimization, which is the cost of capital approach. We will repeat our analysis using the market value of equity. Remember earlier we had used the book value of equity. Now we are going to use the market value of equity, and let's try and identify what is the optimal capital structure that the firm is looking at. What is the optimal debt to equity that the firm is looking at? And then to reach the optimal debt to equity, what does the firm have to do, right? So that's what we're going to look at as we kind of understand. So let's look at this structure and analysis. So it's exactly the same as what we had done earlier, just that we have identified the current debt equity number based on not the book value, but the market value of equity. So the market value of equity at this point of time for Apollo Tyres is 109,000 million, and essentially that when divided by when you divide the debt by equity, you get this number at 0.13. The current enterprise value is market cap plus debt minus cash, which is 117029. The number of shares outstanding is about 509 million shares that the company has, right? Based on that, we identify that the new proposed debt equity structure should be 0.43, right? So that's the proposed debt equity structure. That should be 0.43 when we look at the total value of the data that the firm has. And so obviously to reach 0.43, we will need to figure out what is the current debt to and capital. So total capital that we see is A plus B, and this 0.43 is debt to equity ratio, which means the debt to capital ratio is 0.3. So how much should be the debt out of this? That should be 0.3 into this number. So that's the debt number that we are looking at effectively. That should come out, right? So we're looking at 37,000 million of debt that should come in. If you have this debt, then obviously the equity value will change accordingly, and we'll have some more changes that come across, right? What are those changes going to be? Let's try and assess those changes. So we effectively find out that the new debt that we will optimal debt to equity ratio is 0.43, and hence the new debt should be 37,256 million. The firm needs to borrow an additional 22,679. How do we get this? We take 37,256, which is the suggested debt, and subtract the current debt which is there, which is 14,577, to arrive at the extra money that you have to borrow. And what do you do with this? Either you return it as a dividend to shareholders, or you do a buyback of equity. There's no point leaving the cash in the firm, right? So either you do a buyback, or you return the share as the money as dividends to the shareholders, correct? So that's what we do, and that's what gives us the overall number. Now, what is the difference? What is the enterprise value earlier, and what is the saving that we are doing because of this? So what is the cost of capital? Cost of financing at current debt values is 12.51%. That's the current cost of capital. And then if we identify the new optimal cost of capital, which is the minimized cost of capital approach, that's 12.38. So what is the saving? 0.13%, which is 12.51 minus 12.38%, correct? And this multiplied by the current enterprise value is going to give me the saving that is going to happen every year. Remember, this is the saving you will get every year if you move to the new capital structure. So in a way, this is an annuity and it is a perpetuity. Not even an annuity, it is a perpetuity because it's always going to be there. How do you value a perpetuity? You basically take the number and you divide it by R minus G, whatever is your expected growth rate, correct? So let's go to our Excel file, get to this number 153 and then arrive at this equation as well, right? So we see that annual saving is going to be 12.51%, which is the current debt equity number, minus 12.38% into what is my enterprise value currently. So that's 153.4. That's my current saving, correct? And I will put my terminal growth rate as 4%. That was what we had seen earlier in our calculation. So terminal growth rate is 4%, based on which we arrive at the number of what is the savings every year. That's the perpetuity that we are getting, divided by cost of capital minus the growth rate, right? So we solve for this 153 upon 12.38 minus 4%. What we get is 1825 million. And this is the saving, this is the increase in value. So your enterprise value should go up to this number. Your enterprise value should go up to this number, correct? Let's solve for this. So what we are saying is that increase in value is nothing but 153 divided by R minus G. What is R? The new R is 12.38 minus G, which is 4%. So we get this number, right? So there's a little bit of a change. I will, so that's 1830, and I think if I put this as 153, it becomes 1825. So I just rounded it off to 153 and it becomes 1825 as we look at. So new enterprise value or firm value is the change plus the previous one, correct? Now, what do you think should be the new equity value that the firm should have? So our next discussion should be what should be the share price, right? So now what is the current share price? So I can put the current market price as the market cap divided by the number of shares. So we're looking at 215.3. That's the current share price, correct? What is the value or increase that you get in terms of equity value is what we are going to calculate now. So what is the increase in value? Remember, this is the increase in value, and that's going to go and accrue directly to all the shareholders. So per share value increase can be calculated as straightforward 1825 divided by the number of shares. So ideally, if you do nothing and just move to the free to the new debt equity structure, what that should do is take your new market price to somewhere around 219 rupees, right? That should increase the per share value. That should happen automatically looking at this, but let's assume the company is able to do what is called as a buyback of shares, correct? And let's say you're saying that the buyback price is also going to be 215.3, correct? So what is the additional debt that the company is raising? Let's put that number in here. The additional debt that the company has raised is 37,256 minus the existing debt, right? The company would take these and buy back the shares at a buyback price, and the buyback price we define as the current market price, 215.3. So number of shares that you can buy back or bought back is nothing but the amount raised that you're going to use to return the money or buy back the shares with, divided by this, which gives you 105.33. That's the number of shares that have been bought back, right? Once you buy back these shares, what is the new or net outstanding shares? What is the net outstanding shares? That's going to be existing number of shares, 509 million, minus what you've already bought back. So 403.75 is what is outstanding, right? How do I arrive at the share price? Remember, we have the enterprise value. We also have the debt. We also know the cash because cash was fixed, right? Cash was available here. So that's my cash number. So we know cash. We know the new enterprise value. We know the new debt. Can I arrive at the equity value? Correct? Equity plus debt minus cash gives me enterprise value. Enterprise value plus cash minus debt will give me the equity value. Correct? So let's put in optimal equity value is going to be my optimal enterprise value plus cash minus the new debt we are looking at. That's my equity value. And do I see the outstanding number of shares? We do see the outstanding number of shares. So we can find out the new share price. And the new share price is the optimal equity value divided by the outstanding number of shares. And we find that the new share price that comes up gives us this increase that takes the value of the share to 219.8. 219.8. Correct? So that's how the share price would increase, equity value would increase. Now we may argue that when we did our earlier analysis, we arrived at the share price as 215.3, which is the current, plus an increase of 3.6, that's 218.9. That's the optimal value, correct? But now we arrive at 219.8. So what's the difference, right? The difference is that in this case, you are buying back the share at 215.3, right? Whereas logically, every shareholder should have deserved 218.9. After the increase itself, per share value should have gone up to this. So the buyback price would not have been 215.3 but 218.9. If you put the buyback price as 218.9 in our analysis, note what happens to the new share price that you see below. That will also go back to the optimal per share price. So it seems that if you end up doing the buyback at the per share value increase at 218.9, then you will reach that same optimal share value. Nevertheless, in any kind of case, what will happen is as you keep borrowing money to reach the optimal capital structure, share price will move up marginally to incorporate those changes, right? So that's the important understanding of what we have done here. That's what basically shows us that how does a company create value. So effectively, we have figured out by dividing the increase by the number of shares outstanding. So the first calculation we did was that it would increase by about 3.5 rupees. And then what happens in the case of a buyback, right? So this is the extra debt that we have raised. And let us assume that buyback was at 215.3. So we bought back 105.33 million shares. Net shares after the buyback was initial share capital minus the shares bought back at 215 rupees. So 403.7475 million is what is available. Equity value after buyback is optimal enterprise value plus cash minus debt. Where do we get this? EV is equals to, or enterprise value is equals to equity plus debt minus cash. We're just taking cash and debt on the other side. So it becomes enterprise value plus cash minus debt. Enterprise value plus cash minus debt. That gives me the optimal equity value. Optimal equity value divided by the new number of shares is going to give me the per share value. And that's the important understanding that we have, which is the share price will increase if there is a movement towards optimal capital structure, because that's the minimal cost of capital, minimized cost of capital that any company would basically have, right? So that proves the movement of what happens to the equity value. We come to an end of this particular section. Couple of questions as we end. What should a company typically do after raising more debt? In case the analysis suggests that for their optimal capital structure, we should raise more debt to reach there. And what is the effect of the share price on the share price after raising more debt to reach to an optimal capital structure? Explain your answers. Thank you.